In 2021, a simple transaction on Ethereum's base layer cost between $15 and $50 in gas fees during peak periods. Minting an NFT could cost over $200. Executing a DeFi trade might cost $100, often exceeding the value of the trade itself for smaller participants. These fees were not a bug. They were the inevitable consequence of a network where every transaction competes for scarce block space secured by thousands of decentralized validators. The solution that the Ethereum ecosystem developed is Layer 2 networks, separate execution environments that process transactions in batches, compress them cryptographically, and submit a compact proof back to Ethereum's main chain, inheriting its security while achieving transaction costs 99% lower. By 2024, the dominant Layer 2 networks, Arbitrum, Optimism, and Base, collectively processed more transactions daily than Ethereum's base layer, with average costs below 1 cent per transaction. For institutional investors in Ethereum, Layer 2 growth is not a peripheral technical detail. It is the scalability infrastructure that enables Ethereum to serve as a global settlement layer, and it is a direct driver of Ethereum network fee revenue and, ultimately, ETH value accrual. Layer 2 networks achieve their cost reduction through two primary technical architectures. Optimistic rollups, used by Arbitrum and Optimism, the two largest Layer 2s by total value locked, execute transactions off Ethereum's main chain, compress them into batches, and submit the compressed data to Ethereum. They are called optimistic because they assume all transactions are valid by default. Any actor can challenge a specific transaction by submitting a fraud proof within a 7-day window. If no valid challenge is submitted, the transactions are finalized. The 7-day challenge window creates a corresponding 7-day withdrawal delay for assets bridged from Layer 2 back to Ethereum mainnet, a liquidity consideration for institutional users. ZK rollups use zero-knowledge proofs, a cryptographic technique that proves the validity of a computation without revealing the inputs, to verify every transaction batch mathematically before submission to Ethereum. This eliminates the challenge period, enabling faster finality. ZK rollup technology is more computationally complex but provides stronger security guarantees. Starknet and ZK Sync are the leading ZK rollup implementations. The March 2024 Ethereum Denkin upgrade introduced blob transactions, a dedicated data lane for Layer 2 data submissions that dramatically reduced Layer 2 operating costs. Fees on Arbitrum and Base dropped 90% or more immediately following the upgrade. The Layer 2 ecosystem has rapidly consolidated around a handful of dominant networks, though the competitive landscape remains dynamic. Arbitrum 1 leads in total value locked, the primary measure of DeFi capital deployed on a network, largely through its first-mover advantage and the concentration of major DeFi protocols including Uniswap, Aave, and GMX on its infrastructure. Base, launched by Coinbase in 2023, has grown extraordinarily quickly, benefiting from Coinbase's institutional distribution network and its positioning as the consumer-facing Layer 2 for the Coinbase ecosystem. Base's TVL growth trajectory from zero to major ecosystem in under 18 months is one of the fastest in blockchain history. Optimism hosts the Superchain ecosystem, a modular framework for building interconnected Layer 2 networks sharing the same sequencer infrastructure, with Coinbase's Base built on the Optimism stack. Together, Arbitrum and the Optimism Superchain represent the dominant duopoly of the optimistic rollup category. ZK rollup networks, ZK Sync Era and Starknet, have seen more modest TVL growth to date, reflecting the additional complexity of ZK proof generation and the earlier stage of their DeFi ecosystems, but their security advantages position them as a significant medium-term growth vector. The cost reduction achieved by Layer 2 networks, particularly following the EIP 4844 Denkin upgrade in March 2024, is not incremental. It is transformational. Ethereum mainnet transaction fees during the 2021 peak averaged over $15 for a simple transfer, with complex DeFi interactions costing $50 to $200. On Arbitrum post-EIP 4844, a comparable transaction costs approximately $0.003, 0.03 of a cent. This 5,000-fold reduction in transaction costs fundamentally changes the economic viability of use cases that were previously impossible on Ethereum. Micropayments, streaming a few cents per minute for content or compute resources, become viable at sub-cent costs. Real-world asset settlement, tokenizing and settling fractional real estate or trade finance instruments, becomes economically competitive with traditional settlement rails. High-frequency DeFi trading strategies that were prohibitively expensive at $50 gas costs become practical at sub-penny transaction fees. For institutional Ethereum investors, This cost reduction represents a direct expansion of Ethereum's total addressable market. More use cases become economically viable, driving more transaction volume, more fee revenue to the network, and ultimately more value accrual to ETH as the gas token securing the entire ecosystem. Understanding the value flow from Layer 2 activity to ETH holders requires mapping the economic connections across layers. Users transact on Layer 2 networks, paying fees in ETH or ETH-denominated tokens for the low-cost user experience. Layer 2 sequences aggregate those transactions into batches and submit compressed data to Ethereum mainnet, paying ETH gas fees for the settlement security that Ethereum provides. This means that as Layer 2 transaction volume grows, Ethereum Layer 1 receives more data submissions and collects more fee revenue, even though the individual user is not transacting directly on Layer 1. Ethereum's EIP 1559 fee mechanism burns a portion of all gas fees paid to the network. When Layer 2 activity is high and multiple networks are competing for Ethereum blob space, the base fee rises, and more ETH is burned per unit time. Post-merge Ethereum emits approximately 940,000 new ETH annually through validator rewards. When network activity, including Layer 2 data submissions, is sufficient to burn more ETH than is issued, the total supply decreases. For institutional ETH holders, this deflationary mechanic is an important valuation input. Growing Layer 2 adoption directly supports ETH supply scarcity argument, analogous to share buybacks in equity valuation. 3 institutional risks attend the Layer 2 narrative that must be explicitly modeled. First, sequencer centralization. Every major Layer 2 network, arbitrum, optimism, base, currently operates with a single, company-controlled transaction sequencer. This means one entity determines transaction ordering, consensus-specific transactions, and can halt the network entirely if it experiences operational issues. This is a temporary architectural compromise on the path to decentralization, but it represents a meaningful counterparty risk for institutional users. Decentralized sequencer designs are in development across multiple networks but are not yet in production. Second, ecosystem fragmentation. The proliferation of 50-plus active Layer 2 networks creates a capital and liquidity fragmentation problem. DeFi protocols on Arbitrum cannot natively interact with protocols on ZK Sync. Bridging assets between networks introduces delay, cost, and smart contract risk. This fragmentation is a user experience challenge that slows institutional adoption relative to a single unified network. Third, the tension between Layer 2 scaling and Ethereum mainnet revenue. EIP 4844's dramatic cost reduction for Layer 2 data submissions was beneficial for users but reduced Ethereum's per-unit fee revenue from Layer 2 settlements. If adoption growth does not outpace the per-unit revenue decline, the ETH burn rate could decrease, modestly undermining the deflationary supply narrative that supports ETH's investment case. 5 institutional investment conclusions from the Layer 2 analysis. 1. The scalability problem that previously constrained Ethereum's institutional adoption is functionally solved for current generation use cases. At sub-cent transaction costs and 50 to 100 transactions per second throughput across major Layer 2 networks, Ethereum can support real-world asset tokenization, institutional DeFi, and payments at commercially viable cost levels. 2. Layer 2 activity directly benefits ETH holders. The EIP 1559 burn mechanism creates an economic link between network usage, including L2 data submissions, and ETH supply scarcity. Monitor the ETH annual issuance versus burn rate as a key valuation metric. 3. For institutional participants requiring an L2 environment, Arbitrum and the Optimism superchain provide the deepest liquidity, most developed DeFi ecosystems, and most extensive operating history. 4. Sequencer centralization is the primary institutional governance risk in L2 infrastructure today. Track decentralization roadmaps from Arbitrum DAO and Optimism Foundation as indicators of when this risk will be resolved. 5. Each new protocol, particularly real-world asset tokenization platforms, launched on an Ethereum Layer 2 adds incrementally to the long-term fee revenue potential of the Ethereum network, and therefore to the fundamental value accrual case for ETH as the settlement asset. Layer 2 networks are where the next chapter of Ethereum's institutional adoption story will be written. Crypto mechanics covers every layer of this infrastructure, from consensus mechanics to economic value flows, with the analytical depth that professional investors need. Subscribe now to follow the mechanics that matter for institutional digital asset investing.